The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour on this 24th of June. My pleasure to be here Monday through Friday. Whoa, smackdown. I didn't expect that Great Britain I thought it would be really close with a little slight edge, but the trend that I've been talking about, the trend towards what I call conservatism, has just continued all the way, and you'll see it filtering through. It'll be filtering at some point through the United States. That's just the way trends go. So my bad for not recognizing that it could be a very sharp move to the downside. But I'll show you the charts in a moment. It's really interesting that when you look at some of the key indices, well, we'll do that as we move along. I'll go one at a time here. So the E-minis are down 59. There was a point where it went down, limit down, it went to 1999, a round number low. Was it 1999? Yep, 1999.00. And then it bounced at least 50%, and now it's down 59 instead of being down 119 or whatever it was. At one point, 2046. I did do a renotation here, and that makes this leg D. This entire thing is leg D. I have put a down arrow because I just don't see us making a new recovery high in the next day or two. But what's really important about this is the weekly chart. So let me go through this one at a time. I'm going to run down the numbers. Dow's down 445 at 70,564. S&P's down 58 at 2,047. Comp index is down 150 at 4760. Gold is up 55. It was up much more. We're going to look at those charts in a moment. It's at 1318. Silver is up sharply at up 42 cents at 1777. You've got platinum up. You've got high-grade copper, which is down 3 at 2.12. You've got crude oil at 48. It's down 2. And you've got bonds up over 4 points. And you've got the dollar. And this is very interesting because the dollar is up over 2 at 95.53. Now, let me just go through a couple of things. First of all, the 120-minute chart that we knew yesterday was in the E-mini. That's the continuous contract because I wanted to show the monthly on the continuous E-mini S&P 500 contract made an all-time high. I consider that to be really significant. I think it's a rolling upside move. Keep that in mind. Now, in the meantime, we have to look at this in terms of ESU 16 and the E-mini right now, 120-minute chart, made a peak E at 219.50. Now, what's fascinating, I'm going to go one step at a time. 2119 comes down to 1999. So we're looking at a move of 150 points in total. You bounce back to 2064.75. Very strong move, almost a 50% move. What happens next is going to be really important. So now we can go to step by step through everything else. Have a look at this chart right here. Now, I don't want to be Pollyannish. I don't want to be sanguine. I don't want to be looking through rose-colored glasses. You know, I like to look at things and say, this is what I'm looking at. It's either up or down. I like to make a statement that if such and such happens, we're looking at significantly higher prices. And if such and such happens, we're looking at significantly lower prices. So we'll continue doing that. If you go to yesterday's close, I'm going to blank that out for a moment. Look at the chart. Let me see if in the Tiger TV it comes out the same way that I'm looking at it. I think it is. No, it's not yet. All right, a little bit behind, and maybe not. Okay, if you're looking at this chart right now, if you go to yesterday's close at 18,011, that was the high and the close. This is a very unusual. That made me a little nervous when markets close exactly at the high. However, this particular kind of candle has a little bit of a history where it is a complete candle like that. And the next day, after the high that was made on the 10th of May at 17,934.61, the next day had a lower high of 17,919. And then there was almost the same number of points to the downside, and it's a black candle. There's the white candle, black candle. Now, what's really important about this is that the low that I said to my subscribers, 17,471 is the low. That's going to be the big thing between 17,471 and then the next low of 17,331, the August 2015 low. If that's the case, then what we're looking at, whoops, no sound. Well, I think it's on Tiger TV. If that's what we're looking at, we've just had, at least so far today, a successful test of the low, because the low today was 1 point higher, 17,472. Within this context, if there wasn't, you can't say if this and if that, but I'm just imagining, if there wasn't a news event yesterday, it's as if you're driving along, everything's going just fine, and you get broadsided, bam. And that's really what happened, brick-sided. What's really important is that within the context of this, you've now got a negative MACD, and the stochastic's at 64% and has crossed lower. What's also important about this, the context of this, is that the Dow, now I'm going to go to something else, 120-minute chart, I can show you right here, just to briefly, because it's part of what we're looking at. See, the 120-minute chart made a peak D, and then we gapped down, pulled back, held at 17,471. So that makes this level of 14,471 absolutely critical. Why? Just quick review. I'm talking about the low that was made back right here at 17,471 on the 16th of June. That was tested today and so far successfully. It's not a very good looking candle, I can tell you that. That's a really strong down candle. But what I am saying is that within the context of markets, if you're looking at the overall picture on a longer term basis, the E-mini made an all-time high yesterday. And all-time highs don't just happen in a vacuum. They tend to incur possibly even rolling highs. Remember the Dow 2000 made a high in January. The S&P made a high in March, and the New York Stock Exchange made a high in September, October. So those rolling, but bottoms are made within a day. Remember March the 6th and then March the 9th of 2009? All the lows were made. So the culmination with the VIX skyrocketing. Now I need to show you this quickly before we go to a break. VIX.X, have a look. The VIX index has gone to a leg F. Could be a restart, it could be actually a new B. I'm calling it an F just for now, just days young, calling it an F. And I'm also saying that it's a leg C in the weekly chart. And for a market that had this kind of bad news to now be trading at 21 instead of in the 26, 27 area, so far, that's something quite good. And now we'll look at gold as we're about to go to our first break. And look at that. Gold is in leg D, up 55. And it made a high today of 1362. It's trading at 1318 right now. Very critical. And I'm going to go through some things to say, I'd like to look at both sides, the negative and the positive. I'll be right back. Dow's down 425.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited time, 5-year, market-safe currency comeback CD. This indexed and US dollar denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi folks, just a quick look at the 10-minute E-mini. It's right here. Made a peak E. First one was a peak D from the low of 1999. It went to, what was that, 2043.50 at 4:30 this morning. It pulls back. Trough A, trough B, trough C, trough D. I didn't put it in, but it's trough D. At 216, another round number. Lots of round numbers. That's when there's hectic trading. And then it runs up peak A, B, C, D, and then a spiral right arm extension to a peak E. And that peak E starts the next horizontal resistance line. And we're at 2064.75. And now it's pulling back. And if there's going to be another bounce at all, it has to come from between 2045 and this is the major support level, the Chapman Wave inside track support level, and that comes in around about 2038. You really don't want to go down there. Maximum you want to go down in this move right now is 2043. We're at 2047.50, actually 2045. And then you want to start turning around, make a little U-shaped pattern. And if you look at the NQ, the NQ has got a peak D. Remember, the Chapman Wave looks at 4 higher peaks and tries to identify the lowest low bar. At 4 higher peaks, you start making other decisions. From yesterday, it made, at 10 o'clock, it made the low of 410.75 and went to a peak D, 10-minute chart, pulls back. This is the NQU, the September NASDAQ 100 future. And then it pulls back, starts another ABCD, pulls back at the top right there at 620 last night at 494 round number, and then it goes, and look how it came down. Sharp A, sharp E, sharp C, D, E starts making smaller and smaller until it runs out of downside energy and it makes a low right there at 42, I think it was 42.34.50. And then it starts ABCD. This is now the 1, 2, just in the short period of 24 hours. That's the 4th D, and now you've made the 3rd D, now you've made the 4th D. On the way down, went to an F. Most importantly is look at this little gray line here. Look how it was a repellent line as the market pulled back. Look at the distance between the 9-period moving average and this slower moving average right here. Sorry, right there. That's what I want to look at. This is, I'll show you right now. This is 9 and 18. So we're actually looking. This is the 9 and this is the 18. So what we're looking at here is that we've got the little turn down, but it's still so far kind of positive. We'll see what happens. Here the trend line says that you've got to be very careful. Now I'm going to go back to the big picture. And as I said, there's no way I want to turn this into some kind of happy hour, but I do want to look at the negative. We know the negatives. The negatives are that the domino effect and effect will just careen through all the different markets. That's number one. Number two is the day is young. This is just the first round of the selling and the buying. From 11:30 till 1:30, you're going to get the real ictus. You're going to get whether this is some kind of a bottom that's forming a base, or whether this is a tentative bottom on the way down. And I just wanted to go through these things very carefully and say the GDX, this is the market vectors gold miners, has spiraled on a Friday with news to a gap up leg F. E and F on a Friday in a gap up on news and a stock or anything like that is because it is a Friday. It's the culmination of a week, because it's the culmination of a vote that is going to have far-reaching repercussions. I mean, we haven't even begun to talk about what it's going to mean here in the United States. So I'm looking at this and I'm saying, all right, how on earth could we get that next phase? We were so close yesterday. How are we going to get to the next phase to get to a new all-time high? The prerequisite for even higher highs. You just can't do it unless we're going to get there once. And then we can pull back sharply. I don't care how sharp, but then we should be able to make a second attempt. Now we're looking at the weekly chart of GDX right there at the 200 period exponential moving average of 25.54. It's trading at 26.41. Having hit 27.71, and it's pulling back, but it's in leg D. So the best case that I can see for the GDX is that the gold, now let me just go to gold because we're putting the two together, that gold itself is in a leg F, and this is recycled to a brand new A, and now I have to give it time. I can't say that. I think right now I'm calling it an F for now. What I'm looking at is that there's a chance that over the next 2 weeks, we have this whippy up and down, but in fact, the fear factor of gold, the GDX, of the VIX index might have just culminated, at least on the shorter term, so that there is negative trading with limited upside and slightly lower lows. Could be more than slightly, but let's call them lower lows, lower highs and lower lows for now. But as long as the VIX is in the 20s, it's at 22 right now. This is what I call the fear. This is the gauge of buying intensity and selling intensity. People call it the fear index. I really like into the way I do it. My response to the analysis of the VIX index as I relate to it is it's just numbers. In the 20s, it's selling. You usually get triple digit selling. Goes to the mid 20s, it's very serious triple digit selling. Goes up into the 28 to the 30 area, you're getting close to a climax that could last weeks. We aren't quite there yet. So this is a very important piece. That's why if you aren't in the market, or you've taken some profits, or you've taken a little bit of a loss, but you've basically got yourself out the market, I don't see any problem. There's going to be plenty of buying opportunities, but there's also going to be plenty of shorting opportunities, because this market is telling us now that sector by sector, we can look at what's strong and what's weak. So here we go. The VIX index gaps up on a Friday, spirals from yesterday's close at $17.25 to today's high of 26.24. That is a threefold, more than that. Even now it's up 28%. That is a whopping gain. So how we close out for the week is going to be important. My suspicion is that it's still going to close well above the 20 level, and that's going to suggest be careful. Okay, so now we're done with that, and I'm saying that the fear factor, if I put the whole thing together and I'll lump them as a group, that's the volatility index and gold. All right, so now that I'm kind of done with that, just to say I would not. The question was, would you short the GDX? And the answer is absolutely no. I'd say absolutely. I would not want to short something that is in fact the reflex response to very weak markets. Okay, now The next thing I wanted to do is the EUR. I promised a number of people, and I really do have to congratulate a couple of people who sent me emails saying we had shorted at the close. One person in particular got within a penny of this key indices. Fantastic short position. Now the euro dollar has had a sharp move to the bottom, but what I've been saying is that the euro dollar currency pair has got an arch formation with a peak D in the weekly, and it looks like, based on this pattern, based on the technicals, and I drew it in the monthly chart, that the H, lowercase h in the Chapman wave methodology, should go to a lowercase m. That's number one. Number two is that the weekly chart was showing the same predilection towards retesting at least the midpoint in the 1 point at the time. I think I'd say 1.1 to a little lower. So this says euro dollar is still weak. And then the most important one we'll talk about when I get back is the British pound. I'll finish some of the notations off when we get here, when we get back after this very important message. Dow's down 486, S&P's down 59. I'll be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Now, folks, we're back. So I was asked about NLY, which is a really good question. This is NLY, Natalie. What is it? NLY. I always forget what the actual name is. I always remember the symbol. Annalie, there it is. Annalie. And Annalie looks like at 10.94, it's up 17 cents. Annalie Capital Management, whatever they do, I think they're going to try for $11.14 to start making leg D, mortgage, of course. Mortgage company NLY trading at 1093, 1094 now, up 17 cents. I think it's going for 1114, and that'll be leg D. And that, if it's this month, it'll extend leg A in the monthly chart. It's really the weekly and the daily that are looking very good. The monthly is just beginning to improve. And this is a very positive pattern because this top right here is like a right arm extension, and it usually fails, makes a little bit of a right shoulder, and then breaks down. In this case, it's made the right shoulder because of the news, the current news. It's actually popped up. So far, this is very nice action. J&K, which is the junk, it's the junk bonds. It's the Spider Barclays High Yield Bond ETF. Made a peak once, peak C1, peak C2, could even be called E. And yesterday closed at the high, and then today gapped down, but the candle is trying to fill it in. So this is going to be very important. What happens to the junk bonds? I'm going to take a moment here because this is going to be, I wanted to do this. I was hoping not to run out of time. So let me do this right now. We haven't looked at this for a little while. Got a bunch of questions. I hope I've dealt with some of the questions. I'll see if while this is coming up. Yeah, the VIX index, I think I just spoke about, Paul. I spoke about the VIX index, and those are the parameters that I've spoken about many times. So this has now gone to a D. This is the 10-year. The white is the TYX 30-year T bond yield. The cyan, sorry, the brown is the 10-year note yield, and the cyan, which we've been waiting for to break the left side low of 10.08 that was made on the week of the 12th of February, hasn't, I'm looking at the wrong, 10.16, it hasn't broken it yet. It's got another 9 ticks to go before it breaks it. But this is a formidable pattern. This is a very large arch formation. So what happens at 22.26, the 2.226 in the percent yield on the 30-year is going to be really important for mortgages, etc. What happens at the, actually we've broken all of them. It's now at the lowest level it's been at since it ran higher back in January, February of last year from 16.51 on the 10-year. So let me do this for 1 second here. I'm going to go to the chart itself. Right here. That's TNX. That's the 30-year, 10-year. And the 10-year held the low, the trough E low, and that's going to be important in the daily, because in the weekly it's already gone to a leg, and this is probably a trough E as we're speaking. And in the, this is a G/C in the monthly chart. This is where things get very, very interesting in the 10-year Treasury note interest rate. So I'm looking at that and I'm saying, all right, the Japanization of our bond yields continues. You never know what's going to happen along the way, but this is the theme, and I think the theme is going to continue. So, and especially now with Britain exiting the. So I was going to talk the politics of politics. I'm going to do a whole bunch of things. I'll do it sometime next week. This is not the time to do it. I don't want to waste time. This is a very important session. So here we are. We're looking at the yields, and we're going to see whether the yields do continue lower. If you look at the South African Dow Jones South Africa Stock Index, basically, or fund, it mimics, it's not exactly, it isn't exact, but you'll see that there was a very strong, not even a 50% gain that was made into the early 2016. And now we're consolidating, haven't broken down. I suspect part of that is also because of the goals, although this is an industrial index, but it does have some goals as I recall. Hey, what happened? You're waiting for data. Let me just do this. Click yes, close. There it is. So you've made a peak D in WOOD. That's the Global iShares Timber and Forestry ETF. Remember, that's why I started to get somewhat cautious. And then I thought, okay, I love what's going on in the weekly charts of the market. And we had that yesterday at the close, we had 7 of our stocks longs close at the highs. Not the high, their all-time highs. I'm talking about the highs of the day. And the short that we had was down. And look what happens in one split second. Thank goodness we had that extra premium that was garnered yesterday to give us a cushion on this decline. So it wasn't anywhere close to what it could have been. Imagine if we closed lower, yesterday, much lower, and then gap down. That would have been terrible. Now you've got a peak D in the wood, the iShares Global Timber and Forestry ETF pulling back sharply. You've got a C in the Philadelphia Housing Sector Index. So when I put this together, I say holding quite well in the weekly chart of housing, not holding well in wood, which tells us that that's coming up as an issue. And now what I want you to do is, if I can just find it here. Yes, I want you to look at, is this the comparison? No, it's not the one that I want to look at. All right, I'll find it for the next break. There was a chart that I want to look, oh, here it is, right here. This chart is one that is going to be more and more important. Remember, I drew the and I said, what happens next is going to be key, because so far the New York Stock Exchange, which made its high in September of 2000, plunged when it made a trough B, ran up to a peak A, which became an A minus because it failed as the technicals were fading in 2001. It repeated exactly that process in October of 2007 at 10,387. It ran down, technical started to fail, and then there was that big spike up from a trough B. It went to leg A, that failed, but look at the way the technicals broke underneath the key important moving averages. Then I said, is this with a question mark? Because something's different about this. And when I look at this particular chart, I see that there was a flattening of the MACD, the histogram, the red vertical lines, the 0% line, starting to improve. The stochastic ran up really nicely. This was a change. The price kept on holding for 3 weeks, for 3 months, up until yesterday afternoon. It was holding above the 20-period moving average, the 9-period moving average, all the moving averages, and it was holding in a way that said, this is the first time in this particular pattern that the New York Stock Exchange was able to go to a leg B. Look, every time it went to an A, plunged. Even there when it was a little A, it was just one A and it plunged. This time it went to a B. Is that an aberration? Or was yesterday's driving down the highway and someone comes off the turnpike on the on-ramp and just smacks into you, bam. Are you like a bumper car? You're now deflected against the rail guard, but you still haven't broken down because you're going to continue on your merry way, a little damage, but continuing? Or is this a major smackdown that says the engine has, your pistons are broken, your rings are smashed, and you're going to stall at any point and come down? That's a very big question. And when I look at the weekly chart, today's close, it's going to be really important for the analysis, because the one says there are still good things to come, and the other one says, oh man, what are you even thinking? I'll be back. Basil Chapman, Tiger Technicians Hour, Dow's down 484. We'll be back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. So let me just do this for one more second because I had questions about it. And again, yes, there were here from this low back in 2003, there 2002, 2003 with that candle right there. We had a peak D and then a second peak D, and the top in 2000 was a peak D, an unusual one. It took a little bit to figure out that it was really a peak C that eventually went to a D. In this case, you had 3 iterations. You went to a peak D once, peak D twice, and then the final one was a 4th highest peak D on the 20th in May of last year. So yes, and now look at the difference. I just wanted to point this out. You see how the lines went wiggly down, lower highs, lower lows, and look at this one here. You've done something that's very similar, but the month is still young. We've still got about a week or so to go, and at this particular point, this leg B is suggesting how we close in the New York Stock Exchange, the very broad New York Stock Exchange in June is going to be absolutely key to how you can look at the summer. And my suspicion is that a chunk of the downside move in price has just been done. And now we're going to do the bouncing and testing and all that stuff. And yes, we could go lower down, but will the United States market be considered the market of choice? And if it is, we should know by Wednesday to Thursday of next week. Otherwise, we're going lower lows and lower highs, and all the markets are just going to sink. I think there will be one market where the money starts to come. This is my thinking, and we'll go through that as we move along. Then there was a question about, let's see. So this is a good, Adam Moss, he says, the weekly chart of the ES, that's the futures contract of the E-minis, or it could be the S&P itself or the E-minis, made a peak F engulfing pattern reversal candle. If it takes out last week's highs and lows, it takes out last week's highs and lows. So Brexit, a trend reversed to downtrend now. Also, please compare the crash of the British pound to last year's devaluation of the China yuan, which caused multi-slide in S&P August to now S&P crash in June 2016. Do you have a 10-month cycle here? I'm going to put that, those are really good questions, Adam. I'm going to put them aside. I don't do anything with the yuan, but I will try to put the context of your question aside and try to do it this weekend. Going to have a real busy weekend. Got guests, but I will find time, as I always do, to send out charts, relevant charts. But let me just do 2 things right now. The first is, I was asked about bonds, and if you look at leg D and still pulling back, now only up 4 1/4. This must be one of the biggest moves we've seen in ages. We went all the way to 173 and 25/32 this morning, and the low was 165. That is just a monster move. And now we're looking at the weekly chart with a very long candle. I like to do this whenever I see the candle. I like to do this and say, hey, those are my parameters. I make them smaller, but I'm making them bigger for now. And I'm saying the outside limits are where you should be trading for the next many bars, 3 to 5 bars. But we're in a different economic time frame, all right? A political and economic time frame. However, I've tried to count this in different ways, and I'll still only come up with a leg C in the monthly, the very long term. That's different to the TLT, because the TLT, which is the 20-year Lehman T-bond fund, because if it makes a new high, I can give an alternate count of E/C. And 138.50 is the high that it needs to take out. And we went to 137.56, just under a point away from breaking to a new all-time high for this particular contract. Look at this. Stair-step move, cup pullback, smaller cup pullback. Does that continue this year? Does the Japanization of our bond yields continue? I don't know. So here's the question. Here's the other charts that I want to look at. The QQQ series, I want to look at them in time frames. I've been calling this the weak link, and it's still not bad in the weekly chart. Monthly chart's okay, but I still think it's the weak link because the Amazons and price lines, I think they still need to digest big gains. So that puts me in the camp of saying a rotation through the different sectors in the QQQ. But wait a minute, what about the IYM, not the IYR, the IYM, which has been holding well, and even today it's coming off the lows. Well, I'm looking at this and I'm saying, based on the weekly and based on the monthly charts, if this, a week from today, the close today, 1 week's time, if in fact the IYM breaks the 108 support, it's at 112 right now, I'm looking at something completely different. But if it holds here and even manages to get to 114 or 15, that's really important. Let's go to George in Boston. George, how are you?
Hi, Basil. How are you?
I'm well, thank you.
I got a question for you. I'm looking at a chart in the 30s. Would this chart be similar to the bounce you got up to 1938? It topped out and came down. And the reason I mention it is similarities. It all focused about Europe. Now, in 1938, Germany might have invaded Poland around that.
Right.
And you had turmoil. Now, I don't see this thing phasing out for years because think about this. If you have England, they pulled out. So they're in defiance of Brussels, Germany, right?
Correct. Yes.
Paris. Okay. So now they pull out. So now is Germany going to punish them in France for pulling out, or are they going to be amenable and work with them? Number one. Number two. Now what you hear, and there's going to be votes in Denmark. There's going to be votes in Italy.
In the smaller countries, right? Correct. Yes.
And now, all I'm saying is that this will take at least a year or more to conclude. I mean, so what I'm saying is that when Germany invaded Poland, all right, that was one country. Then Germany invaded the other countries, and our market kept going down to 1942. I mean, you can't compare this to a war, but what I'm trying to say is that it affected one country after the other. So now, say Italy pulls out, or Denmark pulls out, or Spain pulls out. Now, over a year or two, you're going to have all this uncertainty in the world, in the economies. It's going to affect Europe, going to affect China, it's going to affect here. Now, here we're isolated because our economy is considered a safe haven. I'm sure it was in 1938, too, when Germany was invading all these countries.
Well, don't forget that you had the Deutsche Mark going to 50 billion or something. People had wheelbarrows to go and get bread.
That was in the 1920s.
That was in the 20s, right. And then there was some stabilization. And then the dollar, as I recall reading, the dollar became far more stable, and gold became a currency that they were switching around between Britain, the United States, and France. France ended up owing England money for gold, and the United States owed England, and then they used gold after the 29 crash. They started using gold as a currency. Yes.
But what I'm trying to say is that I don't see this thing going away like, say, China over a period of time, 3 or 4 or 5 months, they go into a recession. But you see that coming.
So, George, we've got a break coming. Let's follow this through as we come back. I'll tell you what I'm interested in: the relationship of international markets as it stands now and compared to the late 1920s. And I'll be back and we'll talk about the two things. We'll be back, folks. Okay. Dow's down 480, and we are going to be back with George in Boston.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with Swim Lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
So, folks, the chart that we're looking at is the Dow back in March of 1937. And it made a 381% gain from the 40.60 low of July of 1932. Then FDR became president and started a slow climb and went all the way to 195 from 40. And then it pulled back. It pulled back from 195.59 down to 97.46. And that was the low that was made in March of 1938. So in 1 year, it got cut in half. So, and you're looking at this and saying there's a similarity in international relations. In fact, you don't have to call it war, but it could be economic war, because there's going to be a vying for products. This is what I've been talking about. One of the reasons why I think we're in a period of choice. You can choose to pay what you want. You can buy a small Hyundai for whatever it is, $23,000, get everything you want, or you could spend $123,000 and get a top of the line BMW. And they're both taking you from point A to point B. But the fact is, in the lower price range, the cars are the quality is superior to ever before, and you've never seen that. And that kind of competition is going to be the war that we're talking about, is going to be economic competition. So, George, go ahead.
Well, what I'm trying to say, Basil, the difference in all the recessions and crashes outside of the war and outside of today is that if you think about it, 1929 was from excesses, monetary excesses, whether it was stock market, interest rates, went up, and then the bubble popped in 29. Same thing in 2007, 8. It was financial excesses, and people could see that. The smart people behind the scenes, like they made that movie Big Shot, there were people who saw it coming, and it took a year or two, and you saw all those things coming, okay, excesses. And there were financial excesses, whether it was mortgages, interest rates, whatever.
Right.
Now this, when you look at this is different. This is not a financial excess that's been building up for the last 3 or 4 years because the banks supposedly have plenty of capital. There's not a lot of borrowing going out there. So this isn't a financial excess that's causing this downturn. This is something else.
Well, George, let me just go to 2 points that, you know what? We're about to run out of time. I like this conversation. We don't often have this, but I would like to do this again sometime next week, maybe middle of the week. Let's do it again. We'll follow up because the 2 things that I want to talk about. One is there's a currency war that's going on. There is in fact an economic war below the surface. There's debt. There's the debt that every country is now in Europe is having increased population, and there's tremendous pressure. So let's talk about that next week. But that's a great subject, and we'll talk about it. Maybe I'll put it together with Adam's question as well. Thanks so much for calling, George. I appreciate it. It's given me food for thought, and we'll follow it up, okay?
Thanks, Basil.
Thank you very much. So, folks, let's do this. Real quickly, you're about to go for your swimming lesson. The IYR, the REITs are holding up kind of not bad right now. If you look at the, I want you to go to, I did everything. I didn't do the S&P. The SPX.X right now, look at this weekly chart. So far, it's gone to a peak C, but it hasn't made a new high. So this is called, in the Chapman wave, this is called a retracement failure mode. It just explains that it hasn't made an all-time high, right? But it got so close. 2134 was the high in May of last year. And yesterday, we went to 2120. I think that there's a magnet for higher prices. But in the meantime, be really careful because this has to be digested. There are a lot of implications, but it's not going to be tomorrow or the next day. It's going to take a while for Britain to work things out. And I don't think there's going to be that much pressure in the beginning because the countries need this consumerism to keep going. Hey, folks, have a fantastic weekend. For my subscribers, I'll do my best to get out a lot of charts to be able to explain what I'm looking at, why I'm looking at it, and have just a fabulous weekend. We'll be back here on Monday, and stay tuned for all the great shows. And Steve Rhodes and Steve Listen coming up in his 1 o'clock hour. I recommend you listen to it. Be back Monday.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.